Okay, recording this video Sunday, 8th of December 2013. I want to talk about head and shoulder patterns in today's video. Got some kind of unconventional thoughts in head and shoulders patterns and want to get those down in a video. And the topic was sparked by an email I got this week from Syed, who wrote, Barry, sorry for the basic question, but can you explain what you mean by it's not over until we have an exhaustion pattern on a left shoulder? Thanks in advance, awesome videos. So very quickly, briefly, what is a head and shoulders pattern? What's a left shoulder? This is George Clooney representing some shoulders and a head. And a head and shoulders pattern is a reversal technical analysis pattern where we have price making what's called a left shoulder here, having a little bit of a retracement, making an advance to kind of a maximum point here marked by the head, and then coming back down, testing back up into that kind of extreme region that forms the right shoulder, and when it can't get any further it breaks down into a reversal into a downtrend here. So a couple of things to note. First of all, the dotted line connecting the two shoulder points here is called the neckline, and a break of that neckline with traditional technical analysis is viewed as confirmation that that's a real head and shoulders pattern, and that's now broken into a downtrend. And that this is a traditional head and shoulders pattern on the way up, and you see these inverted on the way down marking bottoms, where you have a left shoulder on a bottom, a head all the way down, a right shoulder testing back down, and then a reversal into an uptrend. So traditional head and shoulders top, invert it to find bottoms. Now let's go to some charts, just show you some traditional kind of head and shoulder patterns. Weekly chart of the NASDAQ 2002. Here's the extreme in price down here marked by a head, and the two pivot points on either side, left shoulder and a right shoulder, gives us a classic kind of head and shoulders pattern from which we advance. Market tops out in 07, again left shoulder, head, right shoulder, drops into a downtrend where we have, this is a little bit more kind of varied in terms of look, but there's definitely a left shoulder and a head. The right shoulder happens quite a lot later and quite a lot at a different price from the left shoulder here. But technical analysis says nothing wrong with that. That's left head and right shoulder kind of happening here. We have a couple very close together, left shoulder, head, right shoulder, dropping off very quickly into left shoulder, head, right shoulder here, and the advance and so on. So there we go. NASDAQ on a weekly chart just showing a whole range of head and shoulder patterns, and you basically see them on any chart in any time frame. They're everywhere. Traditional technical analysis says this about head and shoulder patterns. First of all, it's a specific pattern, part of a range of different patterns that technical analysts have named. So you have double bottoms, triple bottoms, bull flags, bear flags, and so on. The head and shoulders is just one of a whole range of different kind of patterns, either continuation or reversal patterns. The second point is that the neckline is used as the confirmation of the break into a change in trend, and that you can measure the first price target from the head to the neckline. And let me just illustrate that. What an analyst would do, they'd take the distance from the peak in price down to the neckline and project that distance below the neckline to be the first kind of price target on the way down, that you'd kind of take profits on a reversal trade there. So that's what traditional technical analysis says. Let me give you a slightly different kind of take on this. So the first thing is, I almost see all tops and bottoms being made up by head and shoulder patterns, even spike highs, spike lows, double, triple tops and bottoms and so on. And let me again illustrate this with some charts. So for example, this was crude, the spike in crude that we had. Definitely the extreme was marking the head of this move, but if you go back down and find kind of resistance areas on the way up, that would be your kind of left shoulder, and on the way down, where we couldn't make it back up, might be a right shoulder here. So although this kind of spiked, you could say that that was a left shoulder and that was a right shoulder, and the market kind of reversing the other way. Similar with silver, that's definitely the head here. This could be the left shoulder, that could be the right. The neckline is rising trend line at quite a steep angle, but there's nothing in the technical analyst kind of literature that says you can't have the neckline rising or falling. So it doesn't necessarily have to be kind of a level neckline. So all of these kind of types of reversal patterns are valid head and shoulders. British pound, this one's a little bit more unconventional. If the extreme in price was kind of down here, that looks like a right shoulder. We've got quite a lot of volatility leading into this extreme in price, but that could easily be a left shoulder as well. So depending on how narrow your definition of the activity that goes before and after the extreme in price, you can call these left and right shoulders, and effectively all market tops and all market bottoms, because they have an extreme in price, all you're looking for is things that look like left shoulders pivots on the left hand side and the right hand side of that price extreme to form your head and shoulders pattern. So the first comment I would have is that I see them everywhere in all kinds of markets, tops and bottoms, in all kinds of time frames, and I think they're far more frequent than the traditional technical analysts would define them kind of normally. The second kind of thing I would say is look for volume momentum as kind of confirmation of a change in trend and that you've got a left shoulder and a right shoulder. And this is really kind of answering Syed's question specifically. What I look for is volume extremes on the left shoulder, followed by divergence in volume and flushing out volume on the right hand side of price. And again, let me show you this example. So taking the British pound, what I'm going to do is I'm going to switch on better momentum, which is a measure of volume on this pattern here. Now, on the left shoulder, what I'm looking for is extreme selling on the way down, and here's our exhaustion pattern. So better momentum here, measuring buying and selling volume, and with these big cyan dots, that's exhaustion selling volume on the way down here. So price has moved to a left shoulder, and we've got extreme volume kind of going into that move. That is what I'm looking for in order to take profits on the way down and start to say we're now going to go through a period of testing until the final price extreme is reached. And here on the head move you can see we get these flushing out volume patterns. So we put in a first bullish divergence, but that's close to the zero line. That's not kind of good enough. We need to see more selling, but not as extreme selling as we saw on the exhaustion pattern here. So coming into this price move, we have flushing volume, which is flushing out the last of the sellers at that point. Price has gone further, but volume has not. So we've got a divergence happening here. That's showing that even though price has moved further, we've got less selling going on. We then on the right shoulder put in a little bullish divergence pattern, and then we can change into an uptrend. So specifically, Syed, what I'm saying here is on the way down, that's a left shoulder with extreme exhaustion selling, and that's what I'm looking for taking profits on a short trade on the way down here. And then I know after that what we're going to do is going to go through a period of testing and finding that extreme in price where we put in flush patterns or bullish divergence patterns or whatever in order for the extreme in price to be marked from which we can change direction. And you'd see exactly the same thing on a reversal pattern kind of going the other way. Now the second point in terms of confirmation, where traditional technical analysts would look at the neckline as the confirmation, I'd be using my better sine wave indicator to look at cyclical support and resistance areas and tests of that for changes in trend. And to illustrate that, I'm going to go to a 500 tip bar chart. This was Friday's activity where we had, just bunch this up, we had a bottom here with left shoulder, head, right shoulder towards the beginning of the day, then the top at the end of the day, midday we had a left shoulder, right shoulder, head, right shoulder kind of marking the top here. So if we take those two kind of price extremes here, what was going on in terms of better momentum? So on the way down here we had exhaustion, momentum kind of selling down, bullish divergence kind of comes in. On the way up we have extreme exhaustion selling on the exhaustion buying on a left shoulder, testing, and so on. If we look at what better sine wave was doing in the meantime, you can see here we had the downtrend was being marked was still a good downtrend because resistance had held. We didn't have a break of resistance. The market is so weak, resistance has not been overshot. We've just kept on going down. But as soon as we get resistance overshot, that's the first sign that we have strength in the market. And then a little test down to support, cyclical support, holds at this point, and then the market kind of reverses into an uptrend. That exhaustion selling is showing the extreme short covering rally. That's kind of volume kind of buying this breakout, until it sells it all at this extreme on the other way. At the top of the market up here, again what we're seeing, all these support levels are holding all the way up until we have exhaustion buying and bearish divergence comes in at a market top. There's a left shoulder, head, right shoulder, and then as soon as the support level gets broken on the downside, we're moving into a downtrend. This one was very neat because we had a lovely little retrace to get in at this support level here. This break on the way down, we moved straight into a down move. You could have got in on the retest back here, but it was a pullback and a downtrend. It didn't come above the support area. It kind of came in below support area, kind of testing back to the breakdown level and so on. So from my perspective, I'm looking at extremes in volume to mark that left shoulder as areas to be taking profits, and then waiting for confirmation of a change in trend by looking at breaks of support and resistance. So whereas the traditional technical analysts are not looking at volume at all, they're finding, I think, more difficult to actually find that head move because they're not looking at divergence in volume, and they're looking at the break of the neckline as an area of entry into this. And I would say look at cyclical analytical tools like better sine wave in order to identify those break points and entry points. The next thing to say then is, where's the target going to be? Traditional technical analysts are using the measured difference from the head to the neckline to place their price targets, and I would say look for the next volume exhaustion signal in the opposite direction. All the volume that's bought has now got to sell. So again, going back to that 500 tip bar chart here, all the volume that had sold into that extreme point here has to be taken out at the next level up here, either at this exhaustion point or this exhaustion point up here. Don't just use a price target on the way up, use the volume targets as a way of getting out on the reversal side. This market has bottomed at this point. It'll top out when you also see those extremes in exhaustion volume here and here. So specifically, how can you use the better indicators to trade the head and shoulder patterns? And these are my 3 recommendations. The first one is to exit on a left shoulder using the pro signal exit. So use, and I'm going to use another chart example here to show you the 4,500 tip bar chart a few days ago, where the market kind of bottomed, reversed, and went into an uptrend. So assuming you're short into this move here, you can see there's the exhaustion selling on a left shoulder. We have testing of that price point kind of down here with first bullish divergence and flush patterns all coming in here nicely, forming pullback to end of trend on better sine wave and a reversal trade going on here. If you're short into this move, use that pro signal exit, that exhaustion selling on a left shoulder, as a place to get out of your short trade. What I don't want to be doing is mucking around in this kind of area here. I want to be out with the strongest move possible. On the way up, there were a couple of places to get out. This was a day session here. At the end of that day, we had an exhaustion pattern, we had pro signal exit and so on. So again, be getting out of your long trade at that point here. If you were then still in that trade, getting out on this left shoulder here at this exhaustion price is the best thing to do. You don't want to be holding through this kind of junk here where the market is testing and trying to find that extreme before changing direction. So exit on the pro signal exit with that extreme in volume. Don't be waiting to max out, with the British pound example here. I wouldn't be waiting to try and find that extreme in price. I'd be happy just getting out here with the extreme move on the way down and not looking for the absolute bottom in the market. After that, we're likely to get a little bit of testing and bouncing in price. So don't kind of wait around for the extreme in price. Get out at the pro signal exit. The second piece of advice is, I'd say, try and avoid the junk. Wait for the divergence patterns or the flush patterns and the cyclical breaks. This is where you get yourself into the most amount of trouble, because the trend has not been confirmed yet. The change in trend has not been confirmed. You're going to have a lot of testing and backwards and forwards, and all of that kind of junky activity backwards and forwards. That's when things get really tough. And as an example of this, on this 4,500 tip bar chart, after that extreme in price, you can see that the market for 3 or 4 days, and this was leading up into Thanksgiving, was really junky. There was no kind of clear trends here. And I know there's no clear trends because the support levels never got broken. Never got broken. It wasn't until we had this support level that was broken that we had a really strong move, trend move in the other direction. the junk that you have to sit around in here is really tricky to trade. So the advice is, on all different time frames, try and wait until you get those cyclical breaks and maybe retests after a cyclical break in order to re-enter in a different direction. And then lastly, enter on the retests after the cyclical break if it's at all possible. So then going to this 500 tip bar chart here, this cyclical test down here is a perfect low risk entry point. We know that there's strength in the market because we've broken above resistance. As soon as we kind of test back here, that's a perfect little entry point here. Sometimes they don't work out kind of perfectly. This one moved into a downtrend at this point here, pullback to end of trend. That was the first kind of cyclical retest that we had. It wasn't a nice kind of pattern that came in up here. We had to wait till this point here. But if you can, wait till those cyclical levels are broken and then tested before entering reversal trades. So there we go. I hope that was helpful to you in terms of head and shoulders pattern. I'm going to show you one last thing, because if you use kind of multiple time frames, I see this quite frequently. If we look at a little bit of a complex head and shoulders pattern here, we've got a left shoulder being made, the head being made, and then a right shoulder being made here. What I'll often see is end of trend moves in my lowest time frame tip bar chart, so a little pullback to end of trend on the 500 tip bar chart, then followed by a pullback to end of trend on the 1500 tip bar chart, marking the extreme in price, and then sometimes a pullback on the next highest time frame, either going to an end of trend or failing to go to an end of trend on the 4500 tip bar chart. And just because that's actually what's kind of lining up at the moment in terms of the highest time frame tip bar charts. I know this is very difficult to read here, but these are my highest tip frame charts, 4500 to 13500 to 40500, and you can see here we've got pullback to end of trend happened on a left shoulder happening here. Then on the next time frame up, that's formed pullback to end of trend, which could easily be a head move here, which is coming up to cyclical resistance up here, which is pullback kind of to dirty end of trend here, interestingly. So you see these pullback to end of trends rippling through the time frames, and they'll often mark left shoulders, heads, and then testing back up to a right shoulder, and when the right shoulder is kind of in and we get a failure, change in trend kind of going the other way. So I'm going to be very interested to see what happens Monday, Tuesday, because potentially on these higher time frames we've got that kind of reversal pattern coming in, and it's using multiple time frames to kind of signal a head and shoulder pattern. So Syed, hopefully that was helpful to you, a little bit of an explanation of what I mean by an exhaustion pattern on a left shoulder, and just illustrating how the better indicators are used on kind of fairly traditional technical analysis patterns like a head and shoulders pattern. Anyway, I hope your trading is going well. Looking forward to next week.